Hey guys, welcome back to Trade Empire. In this video, you will learn all about the liquidity. And we will cover all these following topics about liquidity. I hope if you watch this video till the end, you will be master enough to identify the liquidity areas in the market. And you will save yourself from liquidity grabs. And you can execute your trades using liquidity trading strategy. So let's start our video. After a short intro. The first question is, what is liquidity? Liquidity means money or big orders that must need to be filled. As market always needs liquidity to generate its momentum. To move into any one direction, in simple words, liquidity is the fuel for the price. So when there are big pending orders, price go to fill that orders and grab the liquidity of retail traders and small banks and institutes. Where can liquidity be found in the market? Liquidity is an area or zone on the chart where a large amount of money is resting, means stop losses, and pending orders. When a trader gets stopped out of a position, market grab their funds and then continue its direction. It is often speculated that central banks or large financial institutes may manipulate the market, creating scenarios that deceive traders into believing that they have a clear understanding of price action. That's why it is crucial to identify the liquidity zones on the chart. If you mark these zones on the chart, they will help you to provide insights into market dynamics and help prevent unnecessary losses. Liquidity can be identified in many different areas on the chart. Sometimes it can be under equal lows and above equal highs, because there is a lot of money and pending orders are resting on these areas. And then market trap the retail traders and grab the liquidity from these areas and stopped out retail traders and small banks and institutes, and then continue moving in its direction. Dynamic trend lines and channels. Liquidity zones can also be identified above or below the dynamic trend lines and channels, because there are a lot of retail orders and positions are placed here, and market needs to hit their stop losses and grab the liquidity to fuel its momentum. Order flows and order blocks. The area where significant orders are placed or pending can also act as a liquidity zone. Support and resistance levels. These specific price levels on the chart that acted as both support and resistance can also be the liquidity zones, because there are many pending orders and stop losses of retail traders are resting there, and market needs to grab them to continue in its direction. Daily candles body and wick. Liquidity can also be found near the body and shadow of the daily candle. Sessions highs and lows. High and low points of trading sessions can represent liquidity zones due to the increase in trading activity and participants' involvement. Fibonacci retracement levels. Many traders look for liquidity around key Fibonacci retracement levels, as these are some common levels traded by many professional traders. Now let's move to some practical examples. Let's take a look to understand the theory of liquidity. This will help you to understand that how price movement occurs in the market to illustrate this concept. Now let's suppose we have a structure like this. And here you can see that overall we have an uptrend, as price is breaking through the structure and making no higher highs. Next, we look for a valid break of structure to the upside. Once a new high is formed, we anticipate a price pullback towards this specific demand zone or point of interest to fill the inefficiency left behind. Always remember, before executing any trade, it is crucial to spot a liquidity sweep pattern that occurs before the price reaches our highlighted demand zone or point of interest. This pattern will indicate the absorption of liquidity and can provide you an opportunity to confirm the strength of the demand in our identified area. We use liquidity sweep as a confluence factor before executing any position. Now the theory is that the market requires liquidity to sustain its movement. And if somehow the price fails to sweep the liquidity before reaching any important point of interest, there is a high chance that price will utilize that zone as liquidity to fuel its momentum, and then it's not safe to trade. In that case, if we have a consolidation phase with equal lows, because our mission is to see the price sweeping the internal liquidity that has accumulated below these equal lows. This equal lows liquidity zone formed by the stop losses of retail traders who open their long positions here, and they think that price will not make a new lower low, and it will change its trend to upside from here. And after that, when we have received confirmation through the liquidity sweep, then our next objective is to see the price entering a higher time frame demand zone. And after that, we will move into the lower time frame, and we will look for any change of character there. Additionally, we have to identify a new point of interest in lower time frame, and after finding these things, we consider going long. And the target will be this swing high of higher time frame. And then we can see that after price reaching at our point of interest, it reversed to the upside and left a significant inefficiency behind, and has created an internal high, accompanied by a small pullback, followed by a sharp upside move. That resulted in a break of structure, and now we have another break of structure to the upside and a fresh swing high. And also a demand zone associated with the break of structure, which has much potential to reverse the price. But if we look here, we have another unmitigated zone near the break of structure. And maybe it can confuse you that which zone to trade. Now let me clear, this zone is not any demand or point of interest. It is just an inducement zone, created by banks and financial institutes. They are designed to deceive retail traders into taking buy or sell positions in the market, to create more liquidity in the market for them. So, I will recommend you to stay away from these areas. And this order block or fake demand zone represents an inducement level, and price artificially attempted to create a structure that would lead traders to believe that the price was about to change direction to the downside, and many traders enters in the market by opening their sell positions and place their stop losses above this internal high, and then the price swiftly moves to the upside, breaks through the structure, and grab the liquidity, and as a result, a fake demand zone and order block forms. And then we can see that price moves downward and reaching the inducement zone. And we have another small pullback to the upside, which is attributed to the buying pressure of traders who executed their long positions on this inducement zone. And this minor pullback further induces more price action traders to enter in the market by opening long positions and placing their stop losses just below this inducement zone. And this type of collective activity creates a lot of liquidity just below this inducement zone. And you can see, price swept the liquidity of these long position traders. And now, our next objective is to monitor the price when it enters the higher time frame demand zone. And when the price tap into this higher time frame demand zone, we will move into the lower time frame, and we will look for any change of character in that lower time frame. And then, we have to find another demand zone in lower time frame. And when all these conditions are met, then we will go long with full confirmation. The stop loss will be below the higher time frame demand zone. And for take profit we will target this external higher high. As now you have learned enough that how liquidity zones can be utilized in our trading plan to increase our profit ratio. Now let's move into some real chart examples. Here on the chart, we have a clear uptrend, as price is breaking through the structure and extending swing highs. And price has left a significant inefficiency. So we will highlight this order block. And we are expecting that the price will reach this order block, fill the inefficiency, and then it will move to the upside. And if we look a little bit closer, we can clearly notice these equal lows. As I told earlier, liquidity can be found above equal highs and equal lows. And it indicates a significant accumulation of pending buying orders and the stop losses of position traders. And the presence of this liquidity above our demand zone increases the probability of a potential price reversal from our highlighted order block. And now, we will wait for the price to sweep the liquidity below these equal lows, fill the inefficiency, and tap into our highlighted order block and point of interest. As you can see, the liquidity below equal lows has been swept, and the inefficiency has been filled. Now our next step is to move into the lower time frame and look for any sign of market shift. Here on the 1-minute time frame, we have this latest downward structure, and this is the recent lower high. And now we will wait for the price to break through this and done a change of character. Change of character has been done. Now market trend has been shifted to the upside. And we will mark this last candle from where this move has started as our order block or demand zone. And we will set our pending buy order at the top of this zone. Stop loss will be a couple of pips below this zone, and for take profit, we will target the swing high of 15-minute time frame. Or you can set 1:2 to risk and reward ratio. Remember one thing, when price is coming to execute your order, monitor the price behavior. If the price is moving more aggressively, set the stop loss below the higher time frame demand zone. After full confirmation, we have a winning trade with high reward and very low risk ratio. So guys, that's all for today. I hope that I explained all the things clearly. And if you are new to the channel, please hit the like button and subscribe the channel for more trading content. Wish you good luck for your trading journey.